We've had a very volatile past several months in the market, and we've seen one by one and in three waves the stock market have a major pullback, largely due to rising rates, but other economic fears as well. The three waves occurred in various different time periods and accelerated in their speed. The first one occurring in February 2021, when the highest risk ARK stocks, the stocks in the ARK complex, began to sell off. Those stocks are down now largely 70, 80, 90%. The next wave was in November of last year. That's when you saw the companies that fit in between S&P 500 companies and small cap high growth stocks begin to fall as the Fed began discussing its pivot. And then the first trading session of this year, you saw finally the big kahunas begin their pullback. So those are the three waves. The first one happened over a year ago. The second one happened about 6 months ago. The third happened about 5 months ago. And then you just went boom. And now we've been in this pullback for some time. And I am seeing signs and fundamental explanations for stability. And I think stability is an okay thing and a good thing. And we should be happy about some stability from a broader economic sense and from an investing sense as well. Why do I think there's stability? Well, first, let's address the rates picture. People are very much concerned about rates, and it's become one of the most consensus trades to assume interest rates are going to go up. As a matter of fact, I benefited strongly from this trade. I was long TBT from last year until this year. Until just a few weeks ago, I began to sell that position down to zero, and it was once very overweight. Like I'm talking 15% total allocation of my portfolio was just TBT, stock and options. So I had a lot of stuff in there. Saw a lot of gains and took them off at, well, it looks like the right time. Why do I see stability in rates? Well, the two most hawkish members of the Fed, Bullard and Waller, have now said that financial markets, aka the Fed futures market, and the 10-year Treasury and other bond markets are reflecting their forecast for the Fed funds rate. Okay, so we're scared about rising rates. People are talking about how rates need to get up, we got to control inflation. But the most hawkish members of the Fed are saying the markets are currently priced for their forecasted tightening of rates, and therefore it's just about follow through. I think this is what's given the market the ability to rally in the last week. Yes, Bostic has said, okay, one rate might come off the table. We may take a pause. And that may be true. But more importantly, the market is beginning to realize that it's not going to get a whole lot worse. We've done the pricing. We've repriced the interest rates. We know what we're getting. The Fed has communicated very well. They have become more hawkish. They are doing tightening at levels we haven't seen in decades and decades. So they're hawkish. They have moved hawkishly already. They've done 2 50 basis point hikes, or 25 and a 50. They're going to do 2 more 50 basis point hikes at least. We know what they're doing. Nobody wants to, be there at the end. They want to move in front. And as far as I'm concerned, and as far as the Fed members are concerned and have said themselves, the market has moved in front. Next, people are afraid of this quantitative tightening. They say, oh, it's just begun. It's about to begin. Just wait for that tightening. Man, oh man, wait for that tightening. Guess what? Just like the rates, the market can move in anticipation of the tightening. We have quantitative tightening of balance sheet runoff. We have 6 months of balance sheet runoff outlaid for all to see. It's not going to surprise anyone. Nobody's going to be caught off guard saying, oh, wait, I didn't know the Fed was going to do that much. I didn't know they were going to take $47.5 billion off starting tomorrow. I had no idea. No. Okay, this is public knowledge. This is beyond public knowledge. This is amongst people who actually manage on a regular basis and are trading these assets, like common knowledge, not just public knowledge. So anyone who's afraid of this quantitative tightening has made their moves. They have sold their bonds. This has impacted interest rates. This has impacted the liquidity of the market. And I don't see a panic sell that's occurred already because people are afraid of $47.5 billion of additional sales per month. That's not a lot, honestly, in the grand scheme of things. The bond market is bigger than the stock market. If people were really concerned about this balance sheet runoff, we wouldn't have just had a fantastic, I believe it was a 7-year auction, CNBC Rick Santelli giving it an A+. That wouldn't be occurring if there was a quantitative tightening next week and people were actually concerned about it and going to be completely off guard, right? People actually use their brain in markets. They have to, because if they don't, they lose money. And that's like the worst consequence to suffer besides, at least in terms of, economic anything, losing money. So people are avoiding losing money. I don't care how stupid you are. You don't want to lose money. If you even look at monkeys, like they gamble, but they know to gamble and not always lose money. Anyways, I think this is overdone. I think these are all just talking points. People, being part of the most consensus trade to be short bonds. Guess what? I was part of that trade too. I've now taken it off. So sometimes you got to be ahead of the curve. And I think people are behind the curve a little bit. They're not thinking as creatively, and they're kind of getting stuck in their ways a little bit and what's been working. Well, guess what? Things need to change. And yeah, we like oil as well. We like oil a lot. But when I hear that, Saudi Arabia might not be as friendly with Russia in production numbers, that brings me back to March 2020, when they just got into a producing war. I am somewhat concerned about oil with this in mind. We've had stability in oil, which is a good thing. We don't want prices flying all over the place. But it's possible Saudi Arabia decides to sign a deal with the EU, who's stopping buying Russian oil, and says, hey, we're just going to produce and produce and produce and produce, and that means price is going down. So I'm keeping a close eye on that. We're going to see what happens there. I'm not selling aggressively today because of that. I didn't sell any energy today, actually, because of that. I'm going to continue to hold some Exxon. I'm very bullish on their renewables projects, their low and no carbon energy solutions, their carbon capture, etc. So I think you get a lot in Exxon. And oil is always going to be used. It's used in plastics, which are in EVs. It's used in tires, which are in EVs. It's used in roads, which EVs drive on. So, the whole oil going to zero thing, it's not going to happen. But 115 is quite expensive. And with the dollar this strong, you're going to see demand destruction in foreign markets. We saw that in diesel. And diesel prices have pulled back. They're still high. They're not as high as they got. So we'll have to see what happens. With the broader market. We got a red day today. Is just a bear market rally. What will make it a bear market rally is if we go up every single day, like we did in that March rally. If you were watching the videos at that time, a few days before, I said it's time to be buying. And that proved to be the right call until we began to approach the peak. And as we were approaching the peak for several days, not just a couple days before, for several days, as we continued to churn higher, I said, I don't like this. We are going up every single day. That doesn't end well. Stocks take the stairs on the way up, not the elevator. We were taking the elevator on the way up, and guess what? We took the elevator on the way down right after. Just a V-shape up and down. I want some days like this. I want some confusing days like this, some up and down days like this, some slightly down days like this, some stability to some extent. I think if we can take the stairs on the way up, not make a beeline to new all-time highs, not have a trajectory to get there in 3 weeks. I think we can chop around and take the stairs and slowly, over time, build a market that's resilient and an economy that's strong. So we want stability. I see plenty of signs that we're getting stability in various areas of the market, and I think that's a good thing. So I'm bullish, but I'm not exuberantly bullish, and I think that's a good way to be. You don't want to be exuberant, obviously, for obvious reasons. We'll see what happens. That's today's video, and until next time, peace out.